Hello everyone, and we are back for another video. Today we will uncover why 99% of real estate investors never make it past 3 properties throughout their whole lifetime. Now, the reason and the purpose of this video is at 30, I've been lucky enough to now close on 45 properties myself in Australia in one of the toughest real estate markets in the world. The amount of capital appreciation and the variance of what people are paid and what properties go for in Australia, there is a massive discrepancy and it is only getting worse. And today we'll discuss the strategy and the main realizations. I'll say the top 3 of why people aren't able to scale their property portfolio and why they literally just get stuck. But before we dive in, massive one, if you could please show your level of support by heading over to my Instagram and leaving whatever's on your mind on the most recent post. That'll be absolutely amazing because I want to see what you guys think and hear and how you feel about the current climate as well. Real estate climate, whether it's around the world or in Australia, let me know, because the more ideas we have, the more ideas I have, and the more I genuinely want to help you. Just remember one thing, I'm not here to sell you anything at all. I don't have any courses, I can't do mentoring, I run multiple businesses and mainly focus on real estate. But what I am here to do is take you through my journey whilst I am 30 years of age. At the moment we're at 45 properties and we will be scaling this portfolio utilizing all the key methods in this video and on this channel. So let's get into it. Number 1, market demand. Everyone struggles to understand market demand, and I don't blame you or me. How do you actually know what the market's doing and what their current demand is? Now, the easiest way to do this is, say if you're on a real estate search website or platform or search engine, and I'll give you the most common one that I use is realestate.com in Australia. You can simply look at a property and then right underneath that, on that very listing, you can look at the suburb profile. And on the suburb profile, as you scroll through, you'll be able to see what current properties sell for, and you might be looking at units. So you can go to units and see what they actually sell for, compare your listing to that. But more importantly, guys, is you want to be able to calculate where your property is currently rented. This is the absolute key. If you're gonna write down anything part of this video, it's what your current property is being rented for when you purchase it and what the current market actually says it's supposed to be based on the historical data it has on that platform. Now, for example, say you buy 5 units for $1 million, and those 5 units naturally return $250 per week. This means that your total yield will be 5 times 250, which is, it is 1,250 for the week. Now, if you then did this search and looked at the property profile and the suburbs historical data, and you saw that units actually rent out for $400, and guys, this is not rare. This is actually quite common. You know there's a massive yield of $150 sitting right there per unit. If you times 150 times 5, that equals, you know what, $750 increase of income per week. Now, overall, I'm gonna break it down one step further, which we can go through another video. When you get these properties revalued, it is based on rental income. And that $750 per week, a simple calculation at a normal yield at 6% will allow you per year to get a valuation of $650,000 additional. But it's important to understand the market rentals currently and the market demand. If you are buying under market demand, it is a good property for you, and you know what you're currently returning based on what you will get. By making some improvements or changing the tenancy profile, there's a lot of gains for you long-term inside that property, which you just never knew about. So that's the first tip. The second tip is cash flow. You always want to buy your property, especially if you want to scale. Look, if you don't want to scale, just don't listen to this. Skip to the next one. But if you want to scale, you want to buy your property when it's already cash flowing. Now, let's go easy numbers. If we had $1 million property that you're purchasing and you're on realestate.com and you're saying, what does this property currently return me at the current rentals that are in there, and say it returns you $50,000 per year, that is 5%. Say if you took a loan out on that property and you paid a 3% interest rate on the actual loan amount, which is more than likely going to be $800,000 in your case, you've got very good cash flow there. And the reason being is because a simple calculation for you would be $800,000 at a 4% interest rate, as an example, is $32,000 of interest repayments you'll pay. Number 1 tip, stay on interest only, because cash cash flow and serviceability will allow you to scale your property portfolio. It's a misconception if you're paying down principal. Stick to interest only. Your capital gains will allow you to build equity in the property, okay? The second thing is, if you're now $32,000, if you've got that as your current repayments for the interest and you're generating $50,000, you've got a variance of $18,000 of cash flow. Of course, you're gonna have some minor expenses. I usually take out 20%. So even at the $50,000, taking out 20%, you've got $40,000 left. And that means you've got $8,000 per year upon purchasing this property. What this means for you, as the owner, the property will actually pay you on a weekly basis, which is phenomenal. You'll actually get paid every single week after all your expenses, after your interest repayments, just to hold that property. In theory, this increases your serviceability, which then allows you, the number one rule, allows you to go and purchase more property, either when two things. You build equity so you can use the equity for the next property, or you save the down payment for the next property. Considering your serviceability is actually increased, you should be able to go and borrow for the second property. If you repeat the formula, you can continue from there. And the third and final tip is location. A lot of people come to me on a daily basis and say, where should I buy? Should I buy in the middle of the city? Should I buy in a regional area? Location is extremely important. And let me tell you why. It depends what you're going to do with that property. However, if you calculate it on what you originally purchased the property at and you ensure that you're cash flowing, location is very critical because you want to know what's happening in that area. Do they have infrastructure building that area if it's a regional area? Do they have more properties built around it? Are the actual property values historically going up in the area continuously, or are they overbuilding in that area, which is very rare in Australia and a lot of countries right now, but are they overbuilding, which then will lower the growth of your property? Now, my biggest tips for location is this. If you are purchasing a property, when historically in the life of all of real estate has property by the water gone down or held? Never. Property near the water always appreciates first before you work yourself inland. So if you're looking at a property as close as possible to the water, you've got two things. The highest possibility for cash flow. It's not guaranteed. Nothing's guaranteed in life, but the highest possibility for cash flow, and number two, the highest possibility for capital gains. The second thing with location is if you are purchasing in an area where it's easy accessible with transport. Transport's a massive plus side because this then opens up your property to students, it opens up your property to travelers, it opens up your property to short-term accommodation, and more importantly, if it's near transport, you can also convert your property with a massive plus side to say, hey, if I now want to do a short-term accommodation, anyone coming from the airport can access this property because it's very close by to transport, and you can also stay here for your short-term accommodation as well. And the most important with location is law and regulation. A lot of properties will have laws and regulations around expanding, around doing improvements, around short-term accommodation, and it's important that you know these factors because, hey, let's face it, you want to be opportunistic, I want to be opportunistic, and even if I have a property or 5 units in one unit block, I want to know that I can Airbnb them, or I want to know that I can actually be creative with them enough where we can scale that portfolio and launch a business within a business. So it's important to understand laws and regulations, and this may be tax implications as well. And the final factor to the laws and regulations is because you don't want to buy a property, hit a ceiling and never be able to move from there. You want continuous growth, and you want to ensure that the area is expanding, because a lot of property investors historically buy a very good piece of real estate and don't realize that even 10, 15, 20 years later, they're able to develop or improve that real estate considerably, and honestly, times 20, times 30, times 40 their portfolio, originally thinking that they're just in it for cash flow. So to summarize, the whole video is number one, ensure from the day one your property cash flows. You'll always be safe. If interest rates go up, if expenses arise, you'll continuously be able to scale your property portfolio. And why 99% of investors can't scale their portfolio is because their serviceability is diminished from a usual single family home or a mortgage time that they're living in. This strategy will allow you to scale perpetually, continuously, forever. And the better you are at doing the deal, the better you'll be able to scale. And number two, look for location as well as understanding your market's demands, because if you have room to grow based on location or based on your market demand, you'll not only be able to increase your cash flow, your valuations will improve, your longevity inside that property will improve, and the level of improvements you can make to that property from those two factors will heavily improve. So guys, good luck with scaling your property portfolio. Hopefully you now jump out of the 99% and enter the 1% of property investors, because if you follow those 3 simple steps, I can guarantee you'll be well on your way. If you have any questions, leave them in the comments below. But more importantly, if you just want to make it private, DM me. We can have a private, confidential conversation, and I can try and help the best I can. See you in the next one.